Picture this, September 1931, Vienna. You're standing outside the Creditanstalt Bank, the largest financial institution in Austria. It underwrites nearly half the country's industry. Steel, rail. Manufacturing, on paper it's untouchable. Then the announcement hits. Massive losses, capital impairment, confidence evaporates in hours, depositors line up, foreign investors pull funds. Within weeks, the panic spreads across Europe. Germany's banking system buckles. Britain abandons the gold standard. Capital flees borders faster than governments can react. Now fast forward. March 2020, the Federal Reserve expands its balance sheet by trillions in a matter of months. Not millions, not billions, trillions. March 2023. Silicon Valley Bank collapses after depositors attempt to withdraw $42 billion in a single day. $42 billion in 24 hours. The lesson should feel uncomfortable. In every systemic crisis, cash looks safe right until it is. Sometimes inflation eats it slowly. Sometimes capital controls trap it. Sometimes banks freeze it. History proves something blunt. The people who survive monetary resets aren't the ones hoarding currency. They're the ones holding the right assets before liquidity fractures. And 2026 is not setting up to reward idle cash. It's setting up for reallocation. The mainstream advice during uncertainty is simple: hold cash and wait. It sounds responsible. It feels disciplined, but history draws a distinction most investors ignore. There's a difference between a cyclical recession and a structural monetary reset. Cash protects you from volatility. It does not protect you from currency erosion, sovereign intervention, or systemic repricing. When governments face high debt and slowing growth, they have limited options: raise taxes, cut spending. Default or inflate. Historically, inflation wins. By the end of this breakdown, you'll understand 6 asset categories that consistently survived periods of monetary stress, from Weimar Germany in 1923 to U.S. stagflation in the 1970s to Argentina's 2001 collapse to Lebanon in 2019. Not hype, mechanisms. If the system resets, you don't want to be holding the melting asset. Let's start with number 1, productive farmland. During the Great Depression, U.S. farmland prices fell sharply, nearly 50% from their early 1920s peak. That sounds disastrous. But farmland continued producing food, and food retained demand. In Weimar Germany, during hyperinflation in 1923, the mark collapsed. Prices doubled in days. Workers were paid twice daily so they could spend wages before value evaporated, but landowners with agricultural production could barter. Grain became currency. Potatoes became purchasing power. Fast forward to Argentina. Between 1998 and 2002, the peso collapsed after the currency peg broke. The currency lost roughly 70% of its value. But soybean exporters tied to global dollar pricing survived far better than domestic wage earners holding pesos. The mechanism is simple. Land that produces essentials maintains demand regardless of monetary instability. Cash is a claim on currency. Farmland is a claim on food, and when systems strain, food outranks fiat. Number 2, energy infrastructure. In the 1970s, inflation in the United States surged above 13%. The oil embargo of 1973 quadrupled crude prices. If you held cash during that period, your purchasing power eroded rapidly. If you held energy-producing assets, revenues repriced upward. Exxon's revenues expanded dramatically as oil prices rose from roughly $3 per barrel to over $12 in less than 2 years. Energy producers weren't immune to volatility, but they passed through inflation. Energy underpins every economy: transportation, manufacturing, heating, electricity. When currencies weaken, energy doesn't stop being consumed, it simply costs more in nominal terms. And today, global underinvestment in fossil fuels combined with geopolitical fragmentation has reduced supply buffers. Energy remains structurally essential. When currency weakens, hard energy assets reprice. Cash does not. Number 3, utilities and water rights. During the Great Depression, regulated utilities, electric, water, gas, remained among the most stable business models. Luxury goods demand collapsed. Utility bills continued. In Argentina's 2001 collapse, while banks froze deposits under the Corralito, electricity still flowed, water still ran. Utilities operate in non-discretionary space. Households may delay vacations, they don't cancel power. Water rights, particularly in drought-sensitive regions like California and parts of Australia, have appreciated as scarcity intensified. The mechanism is non-negotiable demand. When something is essential and scarce, it retains pricing power over time. Cash competes with policy decisions. Water competes with biology. Number 4, precious metals but with precision. Gold is often treated as mythology. Let's strip it down. In 1933, the U.S. government banned private gold ownership under Executive Order 6102. Citizens were required to sell gold to the Treasury at $20.67 per ounce. Shortly after, the government revalued gold to $35 per ounce, a 69% devaluation of the dollar overnight. If you held dollars, your purchasing power fell. If you held gold outside the banking system, you preserved value. In the 1970s, after President Nixon closed the gold window in 1971, gold rose from $35 per ounce to over $800 by 1980. That wasn't speculation. That was monetary repricing, but understand the nuance. Gold is not productive, it doesn't generate yield, it preserves purchasing power during currency stress. In Lebanon's 2019 banking crisis, citizens who held physical gold avoided capital controls that trapped dollar deposits inside banks. Those who held digital dollars discovered they were claims, not cash. The lesson isn't blind accumulation, it's counterparty awareness. If you don't control the asset, you don't control the risk. Number 5, commodity-linked producers. During the 2000 to 2011 commodity supercycle, copper rose from under $1 per pound to over $4.50. Iron ore, oil, agricultural commodities all surged as emerging markets industrialized. Resource producers tied to global pricing benefited from currency debasement and industrial demand simultaneously. Inflation isn't uniform, it concentrates in hard assets first. When fiat weakens, commodities reprice because they're globally traded. If 2026 brings currency stress tied to high sovereign debt and fiscal expansion, commodity producers will not sit still while money erodes. They will reprice. Cash remains static, commodities adjust. Number 6, strategic foreign exposure. History is clear on this. In Argentina, citizens who diversified into US dollars outside domestic banks preserved purchasing power during peso collapses. Those who trusted domestic institutions were frozen. In Turkey, where inflation exceeded 80% in 2022, citizens shifted savings into foreign currency and foreign real estate to escape lira depreciation. In Lebanon, depositors discovered that dollars in a local bank were not the same as dollars abroad. Capital controls made that distinction brutally clear. The mechanism is sovereign diversification. When one system fractures, assets held in separate jurisdictions provide resilience. Cash in a single banking system is concentration risk disguised as safety. Here's the brutal truth. Cash is not a long-term strategy during systemic monetary stress. It is temporary flexibility. In normal recessions, holding cash allows you to buy discounted assets. In currency resets, cash itself becomes the discounted asset. Weimar Germany, Argentina, Lebanon, Zimbabwe, in every case currency holders were punished. Asset holders tied to essentials or global markets retained relative power. Waiting works when the system remains intact. It fails when the system itself is repriced. Now look at the present. Global debt exceeds $300 trillion. Sovereign debt to GDP ratios in developed economies hover at historically elevated levels. Interest payments are consuming larger portions of national budgets. Inflation has cooled from its recent peaks, but structural deficits remain entrenched. Geopolitical fragmentation is reshaping trade flows. Commodity settlement agreements are diversifying. Supply chains are politicized. These are not random variables. They are stress indicators. High debt combined with political gridlock historically resolves through monetary adjustment, not austerity. If 2026 brings renewed inflationary pressure or currency instability, the winners won't be the ones sitting on idle balances. They will be those holding productive, scarce, globally priced assets. So here's your crisis playbook. 1. Own productive farmland or agricultural exposure tied to essential demand. 2. Maintain allocation to energy infrastructure and producers capable of repricing. 3. Consider utilities and water-linked assets tied to non-discretionary consumption. 4. Hold precious metals with clear counterparty control. 5. Gain exposure to commodity producers in stable jurisdictions. 6. Diversify sovereign risk through strategic foreign positioning. This isn't about panic, it's about structural awareness. In 1931, depositors thought their bank balances were secure. In 2026, the equivalent assumption may be digital. History doesn't shout before it shifts. It whispers through data, debt levels, and policy choices. The question is whether volatility returns. It always does. The question is whether you'll be holding melting currency or assets tied to necessity, scarcity, and production. Position before the line forms.